So we'll talk about Chapter 7, stock valuation. Just like a bond is a way for investors, for companies to raise capital, stocks are another way by which companies raise capital. So either the company can raise debt capital through issuing bonds, or they can raise equity capital through issuing stocks. Once the stock has been issued by the firm to the shareholder can now retrade that stock. Meaning, once the shareholder acquires the stock, they can sell the stock to somebody else. Hopefully at a price greater than what they paid, but they can sell it at any price they wish. When that secondary market trade happens, where shareholders exchange stocks, buy and sell stocks, that market is called the secondary market. That type of trading is called the secondary market trading. All of that is reported in what we call the stock market. So the stock market reports all of the buying and selling that happens in the market. And we can follow that market. One of the places where you can follow that market is by going to Yahoo Finance. And once you're here, you can click, if you know the ticker symbol of the stock, every stock is assigned a ticker symbol. Every stock that trades on an organized exchange is assigned a ticker symbol. So I selected Microsoft, and I can see what Microsoft's stock did as of today. The market closed at 4 p.m. Now it is past 4 p.m. So the markets have already closed. We see that the stock ended at a price of $61. This green graph over here shows the trading activity of the stock today, how the stock price changed. It opened at $59.94, ended at $61 approximately. Over here, if I click, I can see what the stock price changes has been over the past month. So a month ago, Microsoft was trading at $57, and now it is trading at $61. So of course, there's been a price appreciation. I can find how Microsoft stock has changed over the year. Over the year, it started at about 54. It's right now at about 61. Again, price has moved up generally. If I can look at a 5-year snapshot, I can see it has significantly changed over the 5 years, going from a stock price of $25 or $26 about 5 years ago to about $61 today. So all of that information is captured on this graph as I click on the different tabs over here. What's interesting about this page over here is we can look at different statistics, market cap, PE ratio, enterprise value to EBITDA. Some of the ratios that we talked about in the financial statement analysis, we can find all that information over here. I can also look at historical data. I can download historical data, and I can play around with that in my spreadsheet. And over here, I get a basic data. I get the open, previous close, the day's stock price range, the 52-week range. I get something called the market cap, something that we have already talked about before, which is the stock price multiplied by the number of shares outstanding. So Microsoft's market cap, or the market value of its equity right now is $474 billion. Its price to earnings ratio is 29.21. And there are some other information like dividend and dividend yield. It pays an annual dividend of $1.56. with a dividend yield of about 2.61%. So all of that is basic information that we can gather. And all of that is essentially happening with trading activity in the stock market. Again, a recap of Nike over here. We can see the same type of information gathered from Google Finance. All of these websites pretty much give similar types of information. What are the things that distinguishes a share or a common stock from a bond? Unlike a bond, shareholders have a right to vote. What do they vote? They vote for the board of directors. And then the board of directors act as fiduciary to the shareholders, and they select or they hire the chief executive. And then the chief executive goes out and builds the rest of the team. Voting can be of different type. They can be straight voting, cumulative voting based on different classes of stock. Detail that you do not have to worry too much about. You can read about it just for quick reading for the purposes of just understanding what are the different classes of voting that shareholders can engage in. Shareholders are also have the option of attending annual meetings where not only board members may be elected, and if they cannot attend, they can vote by proxy, essentially allowing somebody else to vote on their behalf. It has to be all done through legal methods so that the proxy is legitimate and so on and so forth. But at the annual meeting, they also get to hear directly from corporate leaders, the chief executive, perhaps the chairman of the board, outlining what are the successes that have happened or the challenges that have happened in the past year, what are the expectations about the future, and so on and so forth. In addition to common stock, we have another class of stock that we call preferred stock. A preferred stock is neither an equity nor a debt. It is not an equity because it does not have voting rights associated with it. And it is not a debt because it does not have an endpoint where its cash flows end. Like a debt, we saw there was a date of maturity. For stock, there is no maturity date. Cash flows go on forever. As long as the firm survives, the cash flows from the stock will be accruing to stockholders. Stocks are traded on organized stock exchanges. Sometimes they're physical floors like the New York Stock Exchange, or sometimes they're just a collection of computers, a network of computers like we have on the NASDAQ. So different markets, stocks are listed in different markets. It is dictated partly by the choice of the company where they want to list, but also partly by the rules of the exchange. So companies that are smaller tend to be listed on NASDAQ. Companies that are larger and more established tend to be listed on the New York Stock Exchange. When you order a stock, you can place what is called a market order. And in a market order, you're essentially directing your broker to buy the stock at whatever the prevailing market price of the stock is. In addition, you can place what is called a limit order. In a limit order, you specify the price at which you want to buy the stock. For example, if the stock is trading in the market at $10, you may put a limit order to buy the stock at $9.75. So you are waiting for the stock price to dip slightly below 10, and then you say to your broker, when it drops slightly below 10, then immediately jump in and buy. Obviously, you would not put a limit order to buy that is above the current market order. That would make no sense because you can simply buy it at the market order. Conversely, you can put a sell limit order. If you already own the stock, you can tell the stockbroker to sell the stock if the stock is, let's say, trading at 10.25. So you can sell. You can put a limit order to buy or a limit order to sell. And I mentioned about floor brokers or physical floors versus computer systems. Okay. Typically, when you are an investor in a stock, you are buying the stock at P0, and you expect the stock price to go up in price in the future where you can sell it. And over the interim period, you're expecting the stock would pay some dividends. So this is your cash outflow. These are your cash inflows in the future. So your stock price, the price that you would pay today, will be essentially the present value of those cash flows. So present value of those two future cash flows, I simply divide that by 1 plus the required rate of return for equity, or the equity cost of capital. Or you can call it the return on equity. So if I take, since this is the one period model, so this is essentially 1 plus RE to the power 1. If this was a multi-period model, then it would be 1 plus RE to the power 2, and so on and so forth. So thus, from this, I can calculate RE. 1 plus RE would be D1 plus P1 divided by P0. So RE would be D1 plus P1 divided by P0 minus 1. So if I simplify this, I get RE made up of this part, which is this part over here, and then the remaining part over here, which is this part. So there are two parts to RE. That means the return on my equity, return from investing in stock, is made up of the dividend yield plus the capital gains rate. This part is called the dividend yield, and this part is called the capital gains rate. It is dividend yield, as we saw on the Yahoo page. This is dividend divided by stock price gives us dividend yield, essentially telling us what percentage of our cash flows, what percentage of our stock price is, what percentage of our return is coming as a result of dividends. And the second part over here tells us what percentage of our return is the result of capital gains. P1 minus P0 is the gain, my expected gain from investing in the stock. When I divide that by P0, I just convert that into percentage terms. So my total return is made up of dividend yield plus capital gains yield. So here we have a stock pays dividend of 56 cents per year. It is trading at, in the coming year, and it is going to trade at 45.50. If the expected return is 6.80, what is the most you would pay for the stock today? So that means D1 is 56 cents. Expected stock price in the future is 45.50. My expected rate of return is 6.8% or 0.068. So P0 is the present value of these two, which is 43.13. So if I paid a stock price of 43.13, then my dividend yield would be 1.30%, and my capital gains yield would be 6.50%. 1.30 plus 5.50 equals 6.80, which is the total return. Dividend yield plus capital gains yield. Okay. Similarly, you can work on some of these other problems that are very similar. You can just plug in the numbers and try to calculate the stock price and then determine dividend yield and capital gains yield. Okay. Now, what about a multi-year investment? So you are going to invest in the stock today. You are expecting to sell the stock in the future at P2, but in the interim, the stock is paying dividends. So your stock price is going to be the present value of this dividend and the present value of the dividend in year 2 plus the price in year 2. So the present value of the first dividend is this part. present value of the second dividend plus the stock price in year 2 is this part. So together, I can calculate the price of the stock today. If it is multi-year, I take the present value of year 1 dividend, present value of year 2 dividend, present value of year dividend in year n, plus the present value of the stock price in year n. So a series of present values will, and I sum them up, and that will give me the price of the stock. But we just said that in a stock, there is no end date. Because as long as the company is ongoing, the stock has a life. Unlike a bond, the bond's life ends at a certain point. The stock's life does not have an end point. That means this present value sequence has to go on forever. So where do we cut it off? We can't cut it off at an arbitrary point, but we can make certain assumptions. One of the assumptions that we make is that this is dividend 1, this is dividend 2, that these dividends are not just some random numbers, but they're connected to each other. They're connected to each other such that dividend 2 is the dividend that was paid in the previous year times 1 plus the rate of growth. After all, where do dividends come from? Dividends come from the pot of earnings. So if the earnings of the firm is growing, then the dividends that the firm pays out is also expected to grow. So thus dividend in year 2 is dividend in year 1 multiplied by 1 plus the rate at which earnings are growing. So G is called the rate of growth, or the growth rate. If I assume this growth rate to be constant, at a constant rate of G this is growing, and this constant rate of G happens forever, then essentially what do I have as the characteristic of these cash flows? We learned this in the time value chapter. Essentially these cash flows are like a growing perpetuity. And we know in the time value chapter that the present value of a growing perpetuity is the dividend divided by R minus G. The key thing to remember over here is that on a timeline like this, on a timeline, of course this does not end, it goes on forever, it goes on till infinity. So if this is 0, this is year 1. So I'm calculating my stock price at time 0. But the dividend that I have over here happens at year 1. This is year 1 dividend. So if I do not know the dividend in year 1, but I do have the dividend from year 0, as we saw on the Yahoo Finance page, we saw Microsoft's dividend today. Microsoft's dividend today is D0. Then D1 will be D0 times 1 plus G. And then I will divide this by R minus G. So this whole thing on the numerator is my D1. So that's the key thing to remember over here. But this process works if I'm assuming a constant growth rate in my dividend. If my dividends are not growing at a constant rate, then I have to use the long method to price out the stock. I have to use this long method, projecting the stock price in the future and taking the present value of all of these all of these future cash flows. So here we have an example. As you read the problem, notice it says pays $2.30 of dividends. So you know that's dividends. But here is the key part, in the coming year. stating that that's the dividend in the current coming year, that's my D1. That's my cost of equity, RE, and that 2% represents my rate of growth, G. So my formula would be dividend divided by RE minus G. Stock price would be $46. Okay, similarly, you can practice some of these other problems, similar types of problems. Okay. I'm going to skip this section on how to estimate dividends and except just make a mention on how do we calculate the rate of growth. The rate of growth is calculated by looking at the retention rate. Retention rate means the percentage of the earnings that are retained, which is 1 minus the dividend payout rate. What is not paid out as dividends is retained. So I take the retention rate and I multiply that by the return on new investment. Whatever is the return on any new investment that the company is making, and that will give me what we call the rate of growth, G. If there is no growth, how do we calculate the price of the stock? Well, then P0 would be simply D1 divided by R. Because G is 0, so that drops off. So if there is no growth, it is D1 divided by R. And if there is growth, it is D1 divided by R minus G. If there is growth but constant growth. If it is non-constant, then the problem becomes significantly more complicated, and we will not talk about non-constant growth models in this course. If we have dividends and price and growth, we can invert that equation to calculate RE. So we have P equals D1 divided by R minus G, or R equals D1 divided by P plus G. So I can look at, for example, for the Microsoft case, if I look at its dividend, from dividend today, I can project what its future dividend is by calculating the rate of growth. I can find out what the retention rate of Microsoft is. I can find out what its return on new investment is likely to be. Sometimes we can proxy this by looking at the return on equity. We can do that by proxying it. So I can calculate G or estimate G, look at the current stock price, and then I will be able to back out what is Microsoft's, what we call a required rate of return. The return that Microsoft's investors are requiring for investing in Microsoft. Okay. Different other types of problems, you can again work on these. Here is an example. If the dividend payout rate is 67%, then dividend would be the earnings per share multiplied by the payout rate. If earnings per share is 48 cents and payout rate is 67%, then I can get what my dividends are going to be next period. And if the firm says it's now going to be thus retaining 33%, if payout is 67%, its retention rate will automatically be 1 minus the payout rate. So retention rate would be 1 minus the payout rate of 0.67. And if return on new investment is estimated to be 11%, then that established the rate of growth for this firm as 3.63%, meaning that the firm is expected to grow at a rate of 3.6% per year. Okay. Again, work on these problems, repetition of similar types of problems, just plug them in and keep on working them. Okay. What I'm going to skip, I'm going to be skipping certain sections from the book. So I have covered up to this point in the lecture, up to page 204. Then 205, which involves a variable rate of growth, I'm going to skip that. I'm also going to skip section 7.5 and section 7.6. So then we will effectively end our lecture for the stock pricing model over here. Approximately slide 82 of your slides. So, and that will complete for us chapter 7.